This is Alternative Allocations by Franklin Templeton, a monthly podcast where we share practical, relatable advice and discuss new investment ideas with leaders in the field. Please subscribe on Apple, Spotify, or wherever you get your podcast to make sure you don't miss an episode. Here is your host, Tony Davidow.
Welcome to the latest episode of the Alternative Allocations podcast series. I'm absolutely thrilled to be joined today by Jenny Johnson, President and CEO of Franklin Templeton. Welcome, Jenny.
Thank you. It's great to be here.
And it's such an exciting time for Franklin Templeton. You have really transformed the firm and certainly the way that people think about the firm with these acquisitions of great firms like Clarion, Benefit Street Partners, Lexington, Alcentra. Now all of a sudden we're an alternative powerhouse with, $260 billion in assets under management. Why has that been so important to you and the firm as we think about how we're transforming this business?
Yeah, I mean, I have to credit it to back in 2018, we were doing our strategic plan, and we're just watching the growth of allocation by really institutions to the private markets. And, as you got under the covers, it was clear that this was a real secular change in asset management. And so, we looked at it and said, all right, we need to be able to have a breadth of capabilities for our clients. And so, we essentially, our first acquisition was in 2018 of Benefit Street Partners, which, is a private credit manager. And then it has been a very focused effort to continue to build out those capabilities.
Yeah, and you kind of started where I really wanted to take the discussion. Historically, alternative has been the domain of big institutions and family offices. All of these managers really started out focused on that institutional segment, and now I think we're so excited about the opportunities in the wealth management sector. But part of the challenge is we need to educate them. We need to provide thought leadership. We really need to help them think through how to get exposure in the right way. Why has your commitment to education and thought leadership been such an important part of this journey?
Well, so first of all, the reason I think it's really important that these capabilities are responsibly brought to the wealth channel is I think it's akin to, the time where my grandfather got into the mutual fund business. And mutual funds were created because only the wealthy had access to the equity markets, the excess returns of the equity markets at a time where there was tremendous growth. And the average person didn't have access there. So somebody came up with the idea, let's consolidate clients' money and charge a very low fee and give them diversification and liquidity. We're at that same inflection point because there's so many assets that are now and great companies that are now being held privately. And only the wealthy right now have access to that. And, a pension fund has very predictable cash flows because you know how many pensioners you're going to have to pay this year. And so it's very predictable. So it has been very easy for them to allocate a percentage of their portfolio into these private markets, which, can be up to 10 plus years locked up capital. So the challenge, though, is the average investor hopes that they don't have to tap into their savings. But what if they need to tap into their savings? And, too much of their portfolio is allocated there and they can't, for whatever the emergency is, to do it. So this is where it's really important that, one, you explain why there's risk here, particularly from a liquidity standpoint, but there's also a real reward because there are excess returns in these various markets. But, there are also characteristics that can be difficult. And so, our experience is, at Franklin Templeton, we want to be able to provide capability across the full risk spectrum, right? So it can be anywhere from, a money market fund that's almost no risk all the way up to very, very risky, high-octane equity or venture capital. But it's really important that our clients understand the risk they're taking on, right? And so that it is appropriate for their portfolio. And that's why we realize as we're bringing this capability, it requires complicated education both of our own sales force education of financial advisors who bring this to their clients so they can figure out where it's appropriate for clients, and then, of course, to the end consumer.
And thank you, because I think that is so important, right? We want to do it responsibly. I really appreciate that positioning. You talked a little bit about pension plans, and again, we know big institutions have allocated. We have all seen the Yale endowment with 70-80% allocation to alternatives and pension plans. I think based on Preqin data, it's roughly 30% allocation across the board. The wealth channel has historically been around 5%. I think that data is pretty stubborn. But I think we would argue at least there's this confluence of events, right? We have a market environment that is demanding a different playbook, right? More tools at your disposal. We have product innovation, which have made these institutional capabilities more readily available to a broader group of clients, registered funds, interval tender offer funds in particular. But I've argued none of it works unless we have access to world-class managers, which, again, I think is a really important part here because these are very specialized markets. As we think about the wealth management channel and the opportunities, in addition maybe to the commitment that we've made in education, how are we going to get there, and what do we think that looks like over the, if it's 5% today, is it going to be 10%, is it going to be 20%, and how do you think we get there?
Well, first, let me address the point about world-class managers. The dispersion in returns in this category is huge. If you pick an underperforming global equity manager, you might be out a couple hundred basis points. Up till, I think this number was through 2022, that over a 20-year window, the top quartile private equity firms outperformed the bottom quartile by 20% a year. The top quartile real estate firms outperformed the bottom quartile by 10% a year. And the top quartile private credit firms outperformed the bottom quartile by 5% a year. It's so massive. The choice of manager is so important that part of this process is not only creating the right vehicles, but also selecting the right managers. It's really, really important. And it also worries me a little bit as some of this is coming into the wealth channel because folks in the wealth channel have been so trained to think it's all fees, fees, fees. And the only ones in this industry that are ever going to be on sale are the bottom quartile performing managers. And often you're better off being in the public markets than with a bottom performing manager. So that's kind of the first. It's a message I feel is really important to get out there because, as you know, I think like 401k plans are a great place for this, but that's where the fiduciary's first thing they look to is, well, let's just look at fees. But then from there, I think the good news is the kind of product innovation with things like interval funds are making it more liquid, right? So there's an element of liquidity in there, which is going to make it more accessible to more people in the retail channel. But it is still really important that they're selective. And so, for some people, it might be 30% of their savings that they could put in, like a pension fund. And some people, maybe they just don't feel like they could have any locked up capital. And that's why I'm such a believer in the financial advisor who knows that end client and really understands the spending patterns of the end client to figure out what's appropriate.
Yeah, one of the white papers that I wrote that actually has been republished in multiple magazines has really focused on this creation of an illiquidity bucket. I call it the cost of being too liquid. And, there's a couple messages embedded in there. One of those is something you picked up on, which is institutions have been doing this for a long time, but they have the wherewithal to have an illiquidity bucket. They can put the money aside, they hold it, they expect to hold it for 10 to 12 years or whatever the duration is. And even though these structures have more liquid features in them, I'm certainly trying to emphasize to the advisor community that we should think of them as long-term. If you want to get that illiquidity premium, you have to hold it all the way. Although they have liquidity features, if you think you're in it today and out of it tomorrow, you're not going to have the same experience. So I think it's really important we try to condition people to think this is your long-term investment. And by the way, that also helps condition investors to think long-term. As you and I know, everyone says they're a long-term investor until you get market volatility.
Yeah, right. The worst time to pull it out.
Exactly. I did want to pick up on your point. You've mentioned a couple times, the pension plans and their allocations. And, we certainly cite a lot of institutional data in the stuff that we write. it's great to see institutions have been allocating quite a bit to this, but there's been this issue of we believe that it's right and appropriate, but in the DC market, we haven't really seen the follow through. And I think part of it is just maybe a lack of understanding from the regulators or a lack of clarity on how to get those into those funds. But you mentioned 401k plans. I would argue target date funds, 401k plans. It would be great if all retirees could access alternative investments. And I know as a firm, we've looked at that, and I know there's been discussions with the regulators. Any sense of where we are there and where we might be going?
Well, it's interesting. We modeled out just to really try to understand how important, was this important enough to really go through the complexity of trying to do product creation and think through it. And so our solutions team modeled out adding real estate and private credit to kind of a managed account solution. So like a target date solution, but a managed account solution. And just by going anywhere from 10 to 30% of the portfolio in real estate or private credit, it raised, and they were using the average return, right? So if you pick a better manager, your return's even going to be higher than that. They were showing net of fees 1% to 3% a year in a kicker on return. That's huge over somebody's lifetime for retirement. So we looked at that and said, okay, that didn't even include private equity or other types of alternatives. This is worth really getting in there and working with 401k providers and educating them on this. The reason I personally like the 401k is what gets difficult. So mutual funds today can have up to 15% of their assets in illiquid holdings. The challenge for the manager is if the market drops and your illiquids become more than 15%, market drops, people do a bunch of redemptions, you now have breached that number and you can't sort of rebalance it. And so what ends up happening is if they're willing to allocate on a mutual fund to alternatives, they have to keep it low enough that they'll never breach the 15% threshold. So you don't get the full value of it. But in a 401k plan, you always have cash flows coming into that account every time there are paychecks. And so it always keeps, even in market volatile times, you see the flows going into people who, managers who have big 401k businesses because employees not even thinking about it, just gets taken out of their paycheck. So that's good news because it provides that illiquidity. Number two, people don't tend to pull their money out of the 401k plan. And three, there's actually a mechanism for kind of hardship lending. I have a problem, I can borrow against it. And so it's the perfect sort of ecosystem to be able to deliver this. Certainly, as we're first kind of getting into it and introducing it to the channel, again, this is where fees are really important because that's probably the channel because you have fiduciaries sitting over every plan who, easiest thing is to say, well, I picked the low-cost product, that I was focused on fees and that's the easy thing to do. But in this particular case, that is going to end up, I think, with bad outcomes.
Yeah, it's fascinating. I hope you're right because I really feel like everyone should be exposed to these investments in a smart and an intelligent sort of way, and that seems to me to be the one big opportunity we're missing out on. If I could, I'd love to talk a little bit about the investment outlook. You spent a lot of time traveling all over the world. It's great to see you, all over the world talking about alternatives, your passion, my passion. As we look at the environment today, clearly not all opportunities are created equally, but private credit certainly looks really interesting here. We recently had Rich Byrne, president of Benefit Street Partners, on as a guest. And he was talking about how private credit looks very attractive in today's market environment. Secondaries look like they're well positioned as we're seeing a lot of reallocation of capital. And even within real estate, there are sectors of real estate that look really attractive here. I think offices get the headline, but industrials, multifamilies look attractive. What are you seeing, and are there opportunities out there that maybe, we're not paying enough attention to?
Well, I think you hit the big ones. And you take private credit, this is really a secular change because of the response of regulators to the global financial crisis where they raised capital requirements for banks. And so banks' capital is very expensive to them. They only want to use it for their best clients. And so they're not lending like they used to lend. When we look at Silicon Valley Bank's blow up wasn't because of bad credit. It was because of duration and an interest rate portfolio of U.S. Treasuries. So if you look at that, the last sort of people still lending on the banking side were the regional banks. And post-SVB, they're not really even lending anymore. So that's what's created this industry of private credit. And, when you look at private credit managers, the interesting thing is it's just as important. Their underwriting is equally important to their sourcing of deals, the relationships they have with sponsors, the relationship they have with, direct small and mid-sized businesses, kind of like the old banking feature, right? And so they're serving that market, and the reality is it's just getting bigger and pushed more and more out of the traditional banking system into this private credit market. And it's honestly, it's a different risk profile. When a bank lends, every taxpayer and the government is sort of backing those loans through the FDIC insurance. Whereas when it's done through a private credit and raised in a fund, there isn't that same risk of capital, right? It's borne by the investors. And so I look at that, and because there's just less providers, because you don't have the banks in the business as much, our Benefit Street partners in Alcentra would tell you they're seeing the best deals that they've seen since the post-global financial crisis. And let me just, on the Lexington partners and secondaries, I love secondaries. Again, it's kind of the time that we're living in, which is you've had $6 trillion deployed in the private equity arena. You've had about 160 billion raised in secondaries. And if you're an LP, you're not getting as many realizations, right? So you're not getting funding from those private equity investments. And yet they are doing capital calls. So you risk breaching the amount that your investment mandate allows you to allocate to private equity. And if you don't meet the capital calls, you're going to be left out of the next capital calls with that best manager. So if you're with that top quartile managers we talked about earlier, you're going to want to make your capital calls because you don't want to be left out. And so they end up going to a Lexington Partners and say, can you come in here and take, and this is a real transaction they had, take $1 billion off of outside of my portfolio and do it in 30 days. And Lexington can choose the vintages and the managers and buy it at a discount. And the discounts today are 20% on private equity and private credit, and real estate's around 78 cents on the dollar, and venture is only late stage venture, and it's at a 50% discount. So you just look at those, and that's a supply and demand issue. That's not a pricing, right? The valuations have already been valued at what the market feels that is appropriate. They're just getting it because there's not enough secondary managers out there to make those acquisitions.
Yeah, I agree with you. I think it's a really exciting time. And, again, for seasoned managers and people who are long-term oriented, this is a great environment for the private markets. I think that people can be much more selective in how they allocate capital, the price that they pay for private credit, the covenants that you can build in. So really exciting time for us. I'm glad we're having this series and we can share with everyone as we're thinking about the world. I have to ask you, you actually have such a unique vantage point of looking at the world. If you can put on your crystal ball and think about where are we going to be, 5 years from now, 10 years from now, from the growth of alternative broadly, but maybe what the landscape looks like. I mean, we've certainly gone through a transformation. I'd say in the last decade, the rate of change has been incredible, and you can only imagine that rate is only going to accelerate going forward.
Yeah, I mean, I think a lot of the private markets were fueled by the fact that we were in a zero interest rate environment for a decade or more. And there was a lot of people skeptical about whether it would remain once rates raised. But I think there's other factors there. I already mentioned on the private credit side, it's just banks' capital is so expensive now that they're choosing not to lend like they used to. And I think in the private equity space, the reality is, people, if they have a choice CEOs, if they have a choice to remain private, they're preferring to remain private versus going public. If you're a public company, you end up having pressure on quarterly earnings in a time of great technological innovation and change. You need to be investing in things that may not pay off for 5 to 10 years. I think Franklin Templeton's fortunate in that we still have kind of founders that own a nice chunk of the company. So even though we're public, we still have the ability to think a little bit more generationally and longer term. But I think that CEOs are recognizing that that's a hard environment to be in. And so you see it in the numbers in 2000. The average company went public after 3 years. By about 2019, I think it was 9 to 10 years. And by 2022, it was 14 to 15 years. So all that early growth years are being captured in the private markets. And I don't see that changing because of this dynamic around public company and the scrutinies around public companies. So, I think that It's here to stay. When you ask me what does the future look like, I think, one, you're going to have all those categories that still exist. I think energy transition, much more controversial in the U.S., but you see tremendous demand still outside the U.S. and in Asia. And so there's going to be opportunities to invest there. And then honestly, with technology, you're going to see much more personalization that's brought to the individual. And they're going to be able to tilt their portfolios, some private, some public, and with some amount of impact component to it. And they're going to be really customized portfolios. And I think that blockchain plays a big part in all of this and how to figure out a better way to deliver alternatives.
Jenny Johnson, thank you so much. This has been quite a journey talking about where we've been, where we're going, and to me, a very, very exciting future. Thank you for being my guest. This has been terrific, and I hope everyone continues to follow the Alternative Allocations podcast series. Thank you again, Jenny.
Thank you.
And good luck investing, everyone.
Thanks for listening to Alternative Allocations by Franklin Templeton. For more information, please go to alternativeallocationspodcast.com. That's alternativeallocationspodcast.com. And don't forget to subscribe wherever you get your podcasts.
This material reflects the analysis and opinions of the speakers as of the date of this podcast and may differ from the opinion of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Please see episode-specific disclosures for important risk information regarding content covered in the specific episode. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors as local laws and regulation permits. Please consult your own financial professional for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Distributors, LLC, member FINRA SIPC, the principal distributor of Franklin Templeton's U.S. registered products, which are available only in jurisdictions where an offer or solicitation of such products is permitted under applicable laws and regulation. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2023, Franklin Templeton, all rights reserved.